Best Moments episode of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. What is it about market profile that you believe gives you an edge when trading the markets over using other tools?
That's a great question. As you know, they say a trader without an edge isn't going to make a profit. The market, as I said earlier, is a continuous two-way auction process. But how do you organize that? And I think by putting it under the profile, it gives you an ability to look at the structure of the market. If the market is going higher, for example, and, it's really truncated, well, that's a pretty good sign that, yes, it's going higher, but higher prices are not really attracting, more business from the outside. If that market goes too high, too far, too fast, then that's probably an indication that there's too much emotion involved in the market, and that's not going to have staying power. When you get a distribution curve and you see that it's got some symmetry to it, the way it trades, and I'm not talking about symmetry in a bell-shaped curve. There's just some order in which it goes up or down, and it's not too elongated, but it's elongated enough to say you're getting a continual flow of new business coming into the market. And it takes that in order to carry these markets higher. I'm not a profile trader. I only use the profile to organize the market's continuous two-way auction process. But I think that ability to organize the market is just a huge edge. As I say to people, making it really simple, if I had 50 people in my backyard for a barbecue and somebody came in and said, "Hey, Jim, what's the average height of these folks back here?" I have no idea. So what would I do? I'd go out and I'd organize them, tallest ones in the middle and taper it off to the shorter ones were on the outside. I'd now have a distribution curve, right? And I look at that curve. I say, it looks to me like probably about 5'9". And so by organizing the data, I think it gives me an advantage over most others. Working with unorganized data versus working with organized data, I just think that's a very powerful edge when you start to learn to trade. Now, learning to interpret that data, that's that takes some time in and of itself. It's not something that just is there immediately. You have to spend time with it. You have to be able to understand, is this, like I said before, new business or old business? New business that the market was going up would be new outside flow of orders coming in. Old business at the market going up would be a short covering rally. And short covering rallies can actually weaken a market because they remove that potential buying power from the market. So it's important to be able to understand what kind of business you're dealing with in the market, who's doing it, why are they doing it, what's the motivation behind it. And I think the organization of that data under the market profile helps me with that understanding.
All right, so I want to go back to some of the skills that you learned that are essential in becoming a successful trader. And you told me that discipline, respect, arrogance, humbleness, and nonlinear thought process are what you believe are the keys to becoming a successful trader. So let's break that down. Let's go through each one. First one you said to me was discipline. Talk to us about discipline.
Well, yeah, discipline, it's key, and it should be inherent to each individual. Everyone has different risk tolerances. So when I talk to traders or they're asking me this question, I say, well, for me, I know my tolerances. I know how much I want to lose or how much I'm generally wanting to make, and, I think having that balance of knowing both off the get-go and then, having the discipline to stick with that. So when you have a losing trade on and your cutoff is X dollar or X percent, you have to do it. And that's what I mean by discipline. If you don't have that discipline early on, and it doesn't happen, quickly, it's something that, you need to kind of condition yourself for. So that's what I mean by discipline. To be able to pull the trigger when your keys and your triggers say you need to pull the trigger, then you got to do it.
Yeah, see, I love hearing that from you, Mike, because I think discipline is the most overused word by people on social media, people that teach people about trading, because they have to define what discipline means. I think a lot of people look at discipline and they think, oh, just be disciplined to my strategy. And you, like myself, we believe to be disciplined to a process. It's this, it's everything. It's not just saying, oh, the chart or my system says buy here, so I just have to blindly follow that.
Right.
I mean, it's about being disciplined to the whole process. So next thing you mentioned was respect. Talk to us about that.
Well, early on, Transmarket Group, Ray Common was a primary driver of teaching us to respect the market, telling us that it doesn't owe you anything and it can move up or down despite what you think it will do. And I think if you have that, in your mind throughout your whole trading career, you realize that, okay, I may have this quant analysis telling me one thing and I'm going to put my eggs in that basket, but you know what? It could go the other way. And, I think by having respect for the markets, knowing that they can go any which way at any point in time, that's huge. If you know that that's there and you can, first respect that and realize that everything you do, it could change in a heartbeat. So
it's funny, as a new trader, I think back to the beginning of my career and how I felt that I was respecting the market, but I realized that I really wasn't. When I started to lose money and I just didn't have, I basically went into it thinking I was going to be making a lot of money. And then all of a sudden you start having a whole nother respect for the guys that are successful and for markets in general. I mean, to me, it's one of those things where somebody can tell you to have respect for it, but until you actually experience it, it's pretty tough.
Well, yeah, and it always comes up at the wrong times, right? Because anybody can take a winner off. It's the losers that are the problem, and and that brings me to the next discipline that I think is huge, which is arrogance. Because as a trader, you have to be arrogant. I'm sorry. People will say, well, what do you mean? Well, you're a risk taker. You got to have some guts and you got to step out. And that's not inherent to human, general nature. I don't think, at least. But, you need that kind of arrogance because you need to say I'm better than the market. I know what I'm doing, because that helps you actually take that first step and put yourself out there. Because I don't care what any trader, what they'll say about, some guys will say, oh, I can make money, this is easy. Everyone's nervous your first time. Everyone, even if you are arrogant, you're gonna have those second guesses. But I think that is a key as well, is you have to have a risk-taking mentality. And if you don't, it's going to be very difficult to learn.
I agree with that. I think that you have to have a little bit of edge about yourself,
Edge, exactly. Yeah. Yep.
Yeah. And you and I, we're not saying go out and just, like you said, hey, it's easy to make money and then arrogance that way, but you just have to have this self-confidence that you go into it and that, you can do it. And like I said, to me, you feel like I remember watching all the traders on the floor and they all had a little bit of an edge about them, right?
Right.
They were all, you looked at them almost like they were characters.
Yeah, exactly right. Yeah. And that's what, it's a shame that the traders today don't have that, because you really saw the different personalities and you knew the guys that were had the risk-taking mentality. You knew who they were, and
Yeah.
they just had the style and the guts to do things that normal people wouldn't do. And I don't really think you can teach that, to be honest. That's something that's conditioned and learned and inherent to the individual. So that's it's unfortunate that the high frequency and algorithmic trading of today doesn't really have that floor mentality, that vision of the floor and how different personalities are.
Yep. And the next thing you talk about is humbleness. Something that, boy, have I been humbled in this business, man. I'll tell you what.
Have. Yeah. It's something that's the, flip side reciprocal of arrogance. And it's something that, it's usually taking place when things aren't going good. And, the market's told you that your arrogance is now waning. And now what are you going to do? So no matter, and traders go on streaks, they go on runs, and it's kind of like, I think Michael Jordan talked about this. It's called the flow. And that's great. But when you get out of that flow and things aren't going so well and the market's kind of humbled you, and that's when you got to really look deep inside yourself and figure out like why things aren't going the way that I expected them to. And, so the market kind of humbles everybody at certain points. And that's the time where you kind of figure things out. You dig a little deeper, you take a little time off and do a little introvert and retrospect work and see, what skills do I need to work on and why am I looking at things this way and why are they not working out?
Yeah, no, I agree with that. Last thing you talk about is non-linear thought process. Explain that.
Yeah, I think, a lot of people will come into trading in these markets and think like, well, okay, so this guy's making money, I can do it. And, I can look at the chart and we're going, and look at it and say, well, we'll buy it or sell it based upon this. But if it was that easy, then everybody would be successful at it. And it's not. And that's why I consider traders more like artists. And, they kind of have, that type of mentality because I can show two traders the same chart and they'll think different things. And to me, that's always shown me that perception is inherent to the individual. And no matter what we try to tell somebody, they might not see it the same way. So when I'm referring to like nonlinear, I mean like things don't, especially markets, they're chaotic. And you can have a linear process, but you need to have a nonlinear dynamic somewhere in there because it's kind of acts as a filter. And the markets don't always, the equity markets have gone up in a linear fashion, but we all know why. But generally markets are volatile, and you need to know that things don't work in the trading world in a linear fashion.
So you use both technicals and fundamentals in your strategy. So George, can you just narrow it down to a few things that you think gold traders should be looking at on a consistent basis?
Well, on a consistent basis, you have to realize that what is very popular is not a good long-term position because crowded trades tend to not work out in the long run, but in the short run. And right now, the crowded trades are, of course, being short because most decisions these days that we see are price decisions instead of investment decisions. And if you look at gold, which is portable, is liquid, has no political affiliation, and is convertible into any currency in the world, that for the last 5,000 years was the core holding of people who had political or economic or other concerns. However, in the short run, a lot of traders use gold as a hedge, either against the stock market or against interest rates or following currencies and the dollar. Now, the dollar has been very strong for a number of reasons. The rest of the world has had a downturn in economics of anywhere from 3 to 7%, while the uptrend in the United States has been an uptrend of 7 or 8%. And I'm not talking about GDP, I'm talking about stocks. And so U.S. stocks have become a haven for the world as people from all over the globe, especially in countries where either you have a political or a currency upheaval or an economic upheaval, have found that the U.S. is the safest, best, and most liquid place to invest money. Now, when they invest money from all over the world, they need to buy dollars in order to pay for these U.S. securities, whether it's a Treasury security, because after all, our 10-year Treasury is near 3%, while other the government treasuries in, say, Germany or Japan or elsewhere in the world yield almost nothing after inflation. I mean, you have countries where Argentina, for example, interest rate of 60% to try and shore up their currency. You have Venezuela, which is an economic collapse because they don't follow real capitalism. You see what happened in Turkey. You see what happened in Greece. And I always said, you know what happened to us? We slipped on Greece. We broke China. We got in Dutch and took a Turkish bath. And I thought people would get a kick out of that.
Take me through the process a little bit of the mindset you have when you're sitting down going, okay, I want to create an indicator. Like what are the steps that you are beginning with and then ultimately get to the point where you go out and create that indicator?
It's a really good question. I think it depends on the type of indicator that we're looking to develop. But generally what we do is we look at a lot of the common indicators that are out there and what their objective is. And we'll study that indicator. It could be as simple as, an exponential moving average. And we'll take that and we'll study it and we'll look at all the different pros and cons of the indicator and we'll trade. A lot of times we'll trade that on paper, but sometimes we'll trade real money with it. Just getting a better feel of really just immersing ourselves inside of what that indicator is trying to do. And then we'll look at some of the inefficiencies inside of the indicators or how traders struggle to actually generate good trades with these common indicators. And then we'll look to build something either as an enhancement to the indicator or as a completely new indicator if it solves the problem. And so what we'll do is all of us as a company, all of the traders and the analysts that I have on my staff, will sit there and we'll look at this together. We'll go through a robust research and analysis period, and then we will actually trade it for probably a good 30 to 60 days, just so that we can see how the indicator is working in different market environments. And sometimes, you're in a primary trend or a secondary trend. We're technicians, so the way that we look at the markets, we're always looking for the trend change. And we want to see the indicator work in a variety of different markets and timeframes. And then we go back and we back test it, just looking at some different trading strategies. And then after it's gone through all of our stress testing, all of our research, then we will take it to a core group of our students that have been with us for a long period of time, and we'll actually work with our students, which is kind of unique, and get their feedback. So after we're done with that step, then we'll take it to the broad market to help retail traders primarily.
Okay, so you create these indicators, and I know from speaking with you, then you turn some of them into automated strategies where they'll just go in and automatically execute for the setups that you're looking at. Nowadays, this has become such a big part of the industry, is that people want automation. And like I said, you've been doing this for a long time. So after you have the indicator or the idea, walk us through the process a little bit of how you then take that indicator and turn it into an automated strategy.
Okay, sure. So just putting this in layman's terms, what we'll do when we find an indicator that shows promise that can generate algorithmic-based trading signals, what we'll do is we'll actually look at different markets first. So we want to look at not only a specific group of markets, because these algorithms sometimes we'll develop a specific algorithm to a market, say like crude oil, for example. But other times what we'll do is we'll take an algorithm that's a more universal that we'll use inside of multiple different markets. So maybe it's trading crude, maybe it's trading corn, maybe it's trading wheat, maybe it's trading the bonds, different things like that. And so our proprietary process for doing that is it's probably somewhat boring for a lot of people to listen to and very quantitative in nature. But to simplify it down for most people listening to this is that what we do after we get the indicator and we turn it into an algorithmic trading system, it's either going to be specific to a market or it's going to be more specific to a portfolioed approach. And when we do that, we have to run a series of stress tests. We use a lot of Monte Carlo analysis. We run risk of ruin calculations. We go through and we literally run it on several computers. And we have to have server for this because we use so much programming power when we do this that sometimes it takes us several months to perfect a trading strategy. And but when it's finished, when we're finished going through that process, what we're able to do is we're able to come up with a system and show an in-sample and an out-of-sample analysis of the algorithm or the system. And we're able to determine, based all the way down to the minimum amount of capital that a trader or an investor should put into the system in order to generate a specific profit target over a period of time. And then we actually sit there and we look at what the anticipation of the drawdown is going to look like. We're also going to be able to calculate one of our favorite things to look at is what's the risk of ruin. Because one thing I've learned in trading, specifically in the quantitative side, is that the risk of ruin, it's very easy if you don't know what you're doing to burn through that capital very, very quickly. And so you want to have a better idea of how the system's going to operate over time. And you can do that by looking back, obviously doing back testing with today's trading platforms. There's a lot of great tools out there on even retail platforms today, which you can back test. But what we do in our proprietary process is very in depth. And then after we've gone through all of that analysis, we're able to look forward and do the forward testing and see how it should react over time in the future.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. You don't have rules, you have guidelines. Is that correct?
That is, yeah.
Okay, so this is interesting to me because I've written a post on this saying that I have instincts, not rules. So I'm just curious to see if we have similar thinking this way. So talk to me about why you have guidelines, not rules.
Well, I think that people look at it as an if-then, and you have to come up with a risk reward, but you have to have flexibility in the market. There's too much unexpected movement that no one can accurately predict the market. We anticipate different scenarios and manage risk and determine if the risk reward makes sense. One thing that people say is, hey, the market's at resistance. Well, wait a minute. Or, we don't know resistance until after the fact. It's a level of interest where it might show resistance here, but until the prices turn back lower from that point, you can't say it's resistance because it might consolidate through time there, or it might just continue to blast higher. So the hard and fast rules are really, when it comes down to risk management, that if it just starts moving against me beyond my stop, then that's hard and fast. But as far as price targets, that's why I don't like to have price targets so much. Is it's up to the market to tell me, and as long as the time frame I'm trading on continues to show a pattern of higher highs and higher lows, I still want to hold that last third. I've satisfied my urge to get out of some a little bit with that first third, realizing that I'm not there to make a lot of money on that. The second third should be a pretty good profit generally, and then the last third might be, turn into a home run that I hold 3-4 weeks, and just surprises the hell out of me how much you can make with some of those moves sometimes.
I want to talk specifically about futures entries now. Take us through how you approach an entry. Are you scaling in? Is it all at once? Same size all the time? How are you determining your stop? Walk us through that process a bit.
Okay. I would say that I'm putting pretty much the full position on when I'm going in, especially if I'm scalping. And I'm putting a stop in the market immediately, and then going to trade that trade for, a certain amount of P&L. What's a little bit different about the process in this is I may, depending again on the P&L, okay, if we're having a really bad month, I don't really do this because you can't. But if I'm doing okay, my exit point will be less of a profit than my stop point, which people are like, I trade for 3x on my profits, and on my losses, I lose 1x. And I find it really hard to do because really most of the time we never hit 3x or 2x. So for me, I'd rather, scalp it, be in it, and, try to take advantage of the P that I talked about, putting the P on the page and doing the best that I can with it.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.